Thursday, July 10th, 2025, Maneco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with David Jensen of Jensen, david.substack.com. David, welcome back.
Thank you, Mario. It's great to talk again.
Yeah, great to talk with you. I always enjoy our chats. And a few days ago, or I think it was last week, you sent me something you wrote about the LBMA and how you don't trust the LBMA even with a barge pole, so to speak. That a lot of the data that statistics we get out of the LBMA, yeah, it's really like opaque. To me, it seems like I've always said, not just the LBMA, but the COMEX as well, that they're like bucket shops. So maybe you could touch upon that, David.
Sure. I mean, the LBMA, I guess, going back to its origins, it was formed by the Big Bang Financial Services Act of 1986. That was a Thatcher government piece of legislation, and it was incorporated about a year later in December 1987. And what it did was it gave oversight of the London precious metals market to the Bank of England. And the Bank of England gathered together a group of traders. It was essentially one trader from the Rothschilds Bank that oversaw the process of putting in place a set of rules. And I'll put that statement in air quotes, or that word in air quotes, because they were voluntary rules. But what they did was they legitimized the trading of these unallocated spot contracts for immediate ownership of metal. And what that did then, because they were unallocated contracts, it basically turned these cash contracts for metal into virtual assets, digital assets that could be created at the stroke of it. You didn't have to go mine rock and refine it and create the metal. You could just push a button and sell these contracts in London. So what happened after that was there was about another 10 years. And then in January 1997, the LBMA put out in their Alchemist magazine, which is their quarterly magazine, it was Alchemist number 6. They put out the first glimpse that the world had really of the scale of the trading of gold and silver in London. And just an aside here, it's interesting that they choose the name The Alchemist for the magazine of their gold and silver market, because alchemy is really turning dross into gold. And what we're seeing is the London bullion market. They were trading dross, which is paper contracts, and calling it gold and silver. So back to the point again, there was no real understanding of the scale and the size. And then with this Alchemist number 6, we got a glimpse, and it was roughly 30 million ounces of gold that were traded every day, and plus or minus 250 million ounces of silver. And it shocked the gold and the silver world at the time in terms of the scale of the trading. But what wasn't fully comprehended, I think, was that these numbers, how tiny they were in relationship to the actual trading of these paper dross contracts in London. And we got a glimpse of that more than a decade later. The LBMA published this Loco London Liquidity Survey, pardon me, in 2011. And what it showed was that, with less than 2/3, like 64% of the LBMA members responded to it. But we found out that the scale of the trading, the actual gross turnover, we had been given the net end of day net trading, which is, let's say you buy 10 and you sell 9 contracts. Well, that would net out to 1 contract. And that one contract was the number that was being revealed by the LBMA. So what they actually revealed then in 2011 was that in actuality that the trading every day with under two-thirds reporting was about 9.25. But in reality, it was more than 10 and perhaps much greater than 10 because what they didn't say was whether these major bullion banks such as JP Morgan, Chase had responded to this survey of trading. But so in the end, at the time they were publishing figures roughly of 26 million ounces of gold that were trading every day, but the actual turnover was 10 times that, or 260 million ounces of gold a day. So it just absolutely staggering numbers were revealed in terms of the scale of this digital paper claim market that is being used to set the price of gold and silver every day.
So before we go further with our interview with David, just want to speak a little bit about our sponsor today, Incogni. For those of you who didn't know, I'm away on holiday right now. Even when I'm traveling, I still need access to the internet to check my emails and appease the YouTube algorithm by uploading videos for you. I'm sure many of you who are self-employed and don't really get days off can relate. When we're away, though, from home, we will connect to many unfamiliar Wi-Fi networks, and unfortunately, most of them are not secure. Public Wi-Fi networks, including those in hotels, are less secure than private networks. Hotel staff are able to see your online activity even when you browse in private mode, and much of your browsing history will be logged. A technology-savvy hotel guest could actually access these logs. This is what makes hotel networks attractive targets for cyber criminals. You may not even be connecting to the Wi-Fi at all. Hackers use devices called pineapples to imitate networks, and once you connect to it, they have access to all your internet traffic, which they can use to steal your personal information. Hackers will also use Booking.com to do phishing scams. Many people were sent urgent emails asking them to reserve their reservations. These emails looked exactly like the ones from Booking.com, with the only difference being a prove you're a human CAPTCHA. It's the CAPTCHA that's the trap using malicious commands to install Trojan virus onto hotel systems. Once the Trojan is installed, the names, emails, and card numbers of hotel guests are served to hackers on a silver platter. Luckily, Incogni will keep your personal data safe, even away from home. So to get started with Incogni, just create an account and give them the permission to work with you. Incogni scans data broker databases for your personal information and sends out removal requests. Progress reports will keep you informed about your requests, their progress, and how many have been completed. Incogni automatically rescans and keeps adding new data brokers and people's search sites to their lists. So here at Monaco 64, you can enjoy holidays, business trips, and sabbaticals with the knowledge that your data will be safe. So simply enter the code Monaco64 at the link below to get 60% off an annual plan and secure your privacy today. So that 260 million ounces a day, I mean, that was from a survey of only 64% of the participants responding. And you say here that it's 3 times global annual production in 2011.
Yeah, that number 260
I
is
mean,
plus. I think it was 95 million ounces a year was global mine production.
that number is similar also to the total gold reserves of the US, 261 million ounces, which is very interesting. So, yeah, what about silver? Is same kind of scenario?
Well, they never spoke directly about silver.
Yeah,
They in terms of that liquidity survey. So, but roughly similar markets. It could be much worse or somewhat, but we don't know. We don't know. We can just use the scale, right?
yeah.
We're approximating turnover volume, and we can use the same number 10 as an estimate.
D
But suffice it to say that if it was 260, that it would be 2.6 billion ounces that we're trading every day, which is ludicrous when you consider the fact that the vast majority of that is claims for immediate ownership of metal.
Yeah, and you mentioned Rothschilds. They were heavily involved with the LBMA, but I remember actually, I don't know if you've seen, I've spoken about this editorial from the FT in 2004, which is entitled Going Gold. You know, the
Hmm.
pointlessness of holding gold continues to sink in. And in that editorial, they actually mentioned, and I remember it well, that the Rothschilds actually, NM Rothschilds and Sons in London, they actually left the LBMA. And I remember Bill Murphy of GATA basically speculating that they didn't want to be involved because they knew it was a complete sham of a market. But
Hmm.
it's been over 20 years and it's still going. So
Yeah,
yeah,
I think they left in 2005. But what's interesting was that they continued with the fix from the Rothschilds' offices, for a decade after they had left the market. Using their communications equipment and working with that daily fix. So they left, but they didn't fully leave for quite a while thereafter. To smooth the way out of the market. I guess I don't know.
yeah. And I also remember, David, that when I worked in the city, I started following gold in '02 when I bought some gold. And
Yeah.
I used to follow it very closely after that. I didn't, it wasn't part of my job as a broker. I did more government bonds, but I remember the LBMA used to publish the AM and PM fixing on the same day. And for some reason, they stopped that some years ago. So they're not very transparent. It doesn't seem like they really want the public to know what's going on because,
Yeah, they've moved to this digital auction process now, right? Which,
yeah.
you know, it's a number coming out of a box. So trust us.
Yeah. Do you know, even before they had the LBMA, the Rothschilds uh, in their office at Smith Newcourt, I think they started doing the AM and PM fixing after World War I in 1919. So it's been they kind of controlled the gold and silver market for a long time. But I
Well,
wanted to,
they essentially, sorry for interrupting, Mary,
yeah,
but I think they essentially were the gold and silver market.
yeah. I mean, give me control of a nation's currency and I care not who makes the rules, right?
Yeah.
Um,
Yeah.
so I'm gonna just go back to your recent article because uh, you notice there's something else going on now. New London trading volume data released by the LBMA, and you've got some numbers here, and you think they're still underestimating or not really giving the right numbers here. Is this like these numbers here, from 2021 to 2025, like roughly just around two times? Is that two times the net volume? Is that what they're saying it is? And how?
Yeah. So what happened was that they started releasing, during that COVID fright. The LBMA started releasing these, and the data isn't presented in their website, except it can be found in these text releases. And what they did was they started releasing this quarterly trading data to the public back in 2022 that reached back into 2021. And at the back of these releases, there was some data from which we can look at, and compare their net trading volume, which they do publish on their website in a data link. And then we can go back into these releases and then compare to their stated daily trading volume. And we can see that somehow that this gross turnover is now had by then decreased down to a ratio of about one, and that's in the right column there. You can see that it's the ratio of the turnover, the gross turnover, compared to their netted data. And somehow in 2021, that had dropped down to as low as 1.5, 1.4 times, not the 9 to 10 times that they had released in 2011 with their survey of their bullion traders. So we've got this number 10 has now become 1.5 times. And that was quite curious. And you can see there as you go up the column that it increases up to about 3 now, plus or minus. The daily turnover is now 3 times the net settled. So the difference between those two numbers is unclear as to why that is the case. And then if you scroll down, there's another chart there that shows that, that would scale now to 50 million ounces of plus or minus 50 million ounces and roughly 300 million ounces of silver. 50 million ounces of gold and 300 million ounces of silver are traded every day in London. And the vast majority of these trades involve these spot contracts, which are claims for immediate ownership of gold and silver. So the first two columns there give you a sense, or sorry, the first and the third column in
Yeah,
terms of the average daily volume.
yeah.
But
So
go
what you're
ahead.
saying, sorry, is that this ratio number here doesn't make much sense if you go back to what they said from their survey in 2011.
Right. It's greatly different. It's greatly different.
Yeah,
And so the net of it all before we move on is you're seeing the average, and you can see that the highs there, like they've netted them on a weekly basis there in the fourth column. You can see 3.4 billion and 3.2 billion ounces in a week. So, you're running over 600 million ounces a day of silver that is being traded. And in the gold market, it's over 50 million ounces of gold that are being traded every day. And those numbers, now the next section just below that, I said the LBMA trading volume data looks strange. And below you can see that LBMA chart from just the gold market. And we're looking at that and seeing that this is the net settled volume again in millions of ounces a day. But we can see that since from 2011 until today, there's been very, very little change in the net settled amount that is being traded. And yet the ratio, the estimated gross volume has dropped by 85% during this time, according to the LBMA's numbers.
and that doesn't make sense to me, David, because I think the the derivative gold and silver market or the LBMA has become so much more active.
Right,
You look at those OCC data for the US banks.
right,
That's gone like a hockey stick. Those I'm not sure if those derivatives are COMEX or OTC, but it doesn't matter because it seems like everything they do on COMEX they do on LBMA. So like you said, it makes no sense, and you kind of wonder because early this year, and I'm sure you remember it, towards the end of January, that there was that article in the FT basically saying that delivery from the Bank of England for these spot fake contracts, so to speak,
Yeah.
was 4 to 8 weeks. So it looked like people actually wanted the real gold, and it caused a huge problem for the market.
Yeah, I mean, what the FT didn't say was that that was default,
I
right? That
agree.
was
I
technical
agree.
default because
Yeah.
it's supposed to be 2 days.
Yeah, that's right. No, I agree. I mean, I think that's calming down now, that market, because I think the Bank of England has asked, has asked other central banks to lease out the gold so they
Yeah,
can deliver it. But at the time, gold was 2,700, I think. So that's really made a difference to the price.
yeah.
So what do we got here? Who has access to the reactor core? What do you mean by that?
Well, when we look at the London market, essentially it is run by a group of four banks, and you can see that in the illustration below. The London gold and silver market, essentially what they've got is a trade matching system that's a digital black box. And it's owned by the London Precious Metals Clearing Limited in the city of London. And the LPMCL, which is the not a very easy thing to say, but anyways, that company, call it the LP, is owned by four banks, and HSBC, ICBC, which is the Chinese bank, JP Morgan, and UBS. And these four banks owning the LPMCL or the LP have created this Aurum trading platform that you can see there in your illustration. But the company is entirely opaque, and this trading platform is a black box. And so what we get out of this black box is the daily trading, the prices, and the volumes that are published. But there is zero way to independently verify these volumes and that these facts are indeed correct. And so that's a problem is that we have a market here which is basically privately traded contracts run through an opaque black box, and that gives us essentially the global trading, the prices and the volumes in the world's most important gold and silver market.
Yeah, and it looks like you've compared the volume in London versus the Shanghai spot gold trading,
Right.
and it's
Yeah. So
a huge difference, right?
it is large, and yeah, on that point alone, it's like 160 times bigger in terms of the daily trading of gold in London in the cash contract versus the cash contract in Shanghai. And looking globally, in round numbers, London is well over 95% of the global trading volume of cash contracts for gold and silver, because even though they say that 60% of their contracts are spot contracts and 30% are swaps or forwards, each of those swap or forward contracts involves the purchase or sale of a spot contract to create them. So this is an absolutely dominant market that we've got there in London, and there is almost no clarity in terms of being able to verify the digits that are coming out of this Aurum black box, which is run by four banks. And if you do some research on those banks and look at the penalties that they've paid for fraud in various markets, it's not really a great feeling that you get in terms of the virtue of gold and silver, and the determination of the value of this asset, and really the very important impact that gold and silver have on the global bond market in terms of interest rates. Gold and silver have always competed with bonds, even though it's been denied. So it doesn't surprise me as a bond trader, Mary, that you were looking at the gold market. And in fact, that's something that you should have been doing, right, to get a sense of prices for money globally.
Yeah, I remember Gada talking about Gibson's paradox that was some research done on the inverse relationship between bond yields and the price of gold.
Yeah, the price level.
Yeah, by
Yeah, that was a paper that was written by Barsky and
I
Larry Summers.
yeah,
They co-wrote it was the future Treasury Secretary,
yeah,
right?
that's how important gold was for those guys. And the speculation by Bill Murphy was that um, uh, Summers was brought in to be deputy to what's his name, the guy from Goldman that was Clinton's secretary, Robert Rubin.
Robert Rubin, yeah.
Yeah, and that they were the ones who instituted the gold leasing program to keep the dollar strong. They had the
Yeah.
strong dollar policy. But
Yeah.
you also talk. Sorry, do you want to add something?
Yeah, I just want to say so in essence, the gold and silver market in London, which is the world's dominant pricing platform for gold and silver, is essentially turned into a private opaque market that is run behind curtains.
Yeah.
That's the true result now of the Big Bang that came through in 1986 is um, um, that the market itself there was no real liberalization or democratization, if you want to call it that, of the market that happened. It was basically a continuation of the more than 100 years of the gold and silver market being run in a back room. Now it's just a black box instead of a back room.
And I think the reason for that is that they're trying to keep the signals from gold and silver that show that the current system is
Right.
not fit for purpose. And we'll touch upon that at the end because you have
Yeah.
some ideas what could happen. But before we do, could we just go through
Sure.
platinum, what's going
Well,
on?
yeah, one final point here is the scale, just
Yeah,
to estimate the standing claims. But if we've got, in terms of estimating the standing claims, which is, that they're trading a certain volume a day, how large are the scale of the claims in London? In a commodity market, you typically run 2 to 3 times a daily trading volume is representing the standing claims or the claims that are extant in a market. And if we're looking at gold, that would be 100 to 150 million ounces of gold in terms of if we accepted the numbers that are being published on a quarterly basis by the LBMA. And then, if we're looking at 500 million ounces of silver being traded every day, um, you're looking at basically 1 billion to 1.5 billion ounces of cash claims that are in the market. But what I'm noting here is the fact that when you have a market like London, there are funds around the world that are holding these promissory notes, believing that they own gold and silver in their investment portfolios. And so this is a very different market in terms of owning a cash claim in London for delivery versus holding a commodity futures contract, such as is traded in the CME and the COMEX in New York. And so the potential here, and I think it's a likelihood, is that there are far more claims standing in London than these 2 or 3 times the daily trading volumes, more than the 150 million ounces of gold and 1.5 billion ounces of silver that are standing in London. And that's the other part that we're given no idea of, from that black box reporting system that the LPMCL is running there in London.
I see. So, yeah, I wanted to touch upon platinum very quickly.
Sure.
I
Final note is that they
yeah,
publish the vault holdings,
yeah,
but they don't publish the claims against those vault holdings.
yeah. Well, yeah, that's yeah, that's what made all the difference, I guess, back in January. Uh,
Yeah.
but you didn't hear like the FT or anyone in the mainstream mention that. We were told that it was because it was very heavy. and there
Yes.
was a lorry or a truck that blocked the exit to the gold
Right.
vaults at the Bank of England. So, but anyway,
Yeah,
yes,
the Bank of England covered up with gold that was owned by the public, and they leased that into the market to cover up the gap between what was available and what was claimed at the time.
yeah, yeah. Yeah, and I think they leased other, they hold almost 5,000 tons for foreign institutions. They probably made use of that too, because
Yeah,
the UK itself only holds about 310 tons. But I guess yeah, that's what happens. So
yeah.
yeah, so what are you seeing in platinum? Is it even worse? I guess it's even worse because they can't really lease any platinum. Central banks don't hold platinum, right?
Yeah, I mean, there's nothing published in terms of trade volumes and open interest of platinum and palladium in the LPPM in the London market. If you go to the LPPM website, you can just see the data section, just a series of daily prices, and that's it. That's it. But it was interesting because I was doing this research in terms of trying to estimate volumes of trading and the amount of claims that were in the platinum market. And I ran into this document that's published again as a release, but not available in the drop down menus in the LBMA or the LPPM. But it was a snapshot that was taken, and they've published five of these now since the early 2023. And they basically give a snapshot of the dollar volume. And then I recognize that they're giving dollar volumes of trading on a daily basis in London. And if you get the average prices, then for what's traded, then you can estimate the average volume that's being traded in the market. So I dug up the platinum and palladium average prices there from Johnson Matthey. And then from that, we can see that the daily trading volume in palladium has gone from around 1 million to about 2.75 million ounces a day. And palladium has gone, that was for platinum, and palladium has gone from roughly 500,000 to about 1.1, 1.2 million a day. Um, but we know that we've seen 25% lease rates in London in terms of the cost of these traders that the traders need to pay in order to deliver palladium, in order to deliver platinum to those who are serving up these spot contracts and asking for delivery. And if you look at their trading, let's call it 3 million ounces a day on average. So the high volume would be above that in terms of the volatility of the daily trading volumes. But that's an 8 million ounce a year market in terms of the total production. This is the third year that it's run more than a million ounce deficit. And then looking at these numbers again, seeing that they're trading roughly 3 million ounces a day of cash claims in this market is again, it's ludicrous given the scale of this market and how very tight it is. Right. If you look at palladium, I think there's of the order of about 50,000 ounces in the vaults in New York that are available. And it's roughly 350,000 ounces of platinum that are in the vaults in New York that we can see. We can't see how much is in the vaults in London, but again, this 25% lease rate is telling us that it can't be a whole lot. So this gives us a sense here that there's probably a very good reason that they're not reporting any of this data and that we have to find it inferentially by working backwards through occasionally reported statistics in London.
Yeah, yeah. So more like opaqueness in that market, not surprising. So to wrap up, David, we were speaking before we started, and I asked you, do you think eventually the London bullion market, which really has dominated gold trading for like 150 years. It was even before the Big Bang in 1986. I asked you if you thought that would be replaced by Shanghai, by Chinese market, and you said no. So maybe you could tell us what you think will happen eventually.
Yeah, well, right now and for 4 decades, essentially, we've had the value of gold and silver set by these alchemists in London that are running this exchange with their black boxes, digital black boxes recently, and backroom black boxes before that. And I don't see this as ultimately that we're going to have a series of fiat exchanges for gold and silver, because I think what's happening is that gold and silver are asserting themselves in a rolling process. It's nothing's immediate, but that over time they are reasserting themselves as money. And I think what we're seeing here is that we're going to have fiat revulsion take over the market, and that in order to settle trade and complete exchange contracts, the process to settle it out with payment, that people are going to be demanding gold and silver. So I don't see these fiat exchanges as the idea that I think that the idea that China is going to open up these exchanges around the world to have the yuan accepted. Well, I think that'll work short term. But I think in the end, that when people see the consequences of the rapid devaluation of fiat currency occur, that individuals are going to demand settlement in gold and silver. And so I think that they don't become fiat exchanges as much as they become metal settlement exchanges. I think that's what's going to be the end result of this.
So
And
I,
and the importance of it, Mario, one last point is that the continental currency that was utilized during the Civil War, the consequences of the devaluation and the disruption to society that occurred, if you look back at I think it was the Currency Act of 1792.
oh yeah, the continental currency during the Revolutionary War, you mean?
Right.
Yeah, you said the Civil War, but it doesn't.
Yeah. Oh, sorry. It was the Coinage Act of 1792 that
And
came
that
out of that.
came after that, yeah.
Yeah. And the Coinage Act had a provision in it that specified the death penalty for employees of Treasury who were diluting the currency. And that's a pretty severe penalty. But I think that the message there was that the decay in the value of the currency is so disruptive that they had a very stern punishment built into that act to ensure that it didn't happen. And maybe looking big picture now is that what used to get the death penalty in 1792 is now done every day by the Federal Reserve. That's how much we've slid.
Yeah, and through the bullion banks, I guess. And so
Yeah.
I guess what you're saying eventually, what you see is that, well, of course, gold and silver are money, and there won't be a fiat price. There will be a price versus goods, services, financial assets. I mean, people are just
Yeah. Like how
looking
do you
at
buy a
that.
dollar today, right? Well, a
Yeah,
dollar is a dollar, right?
yeah,
But
yeah,
so
yeah,
it'll flip.
yeah. Very interesting. So, yeah, David, it was great talking with you again, and I'm gonna keep an eye on your Substack, and I highly recommend the viewers to go there. I'm gonna put a link to it below in the description. And yeah, before we wrap up, any final words for uh, the viewers? A lot of them have been stacking gold and silver for years. Yeah.
Yeah, I maybe just leave you with a thought that I think the most critical markets in terms of shortage in London are the platinum and palladium markets. And we may get a signal out of that lateral market that ripples through to gold and silver as a knock-on effect. I mean, we've seen copper, right? You've seen the LME stocks of copper, how tight they are. and that is getting squeezed. And I think that we're likely to see a continuation of this platinum and palladium developing squeeze in that market, and that it'll knock on. I would expect all of these markets to run together in the end, and it won't be very, time wise, it won't be a great deal of time from one breaking until the other ones break as well.
Great. David, thank you. And I wish you a great rest of the day.
Thank you to you too, Mario.